good evening, and it's a pleasure to be here. And today we are here to talk about climate and energy financing in the context of the energy transition, but specifically the investments that are being drawn across the world into low carbon businesses, and how does that affect the balance of energy sources. So very quickly, I'll introduce the panel. We have a good mix of users of finance and providers of finance. We have with us Pratima from Climate Investments, Mr. Das, who heads IREDA, Mr. Vaid, CFO of Cairn, Mannish, Chairman of Invenire, and Rouzbeh from Houlihan Lokey, the investment bank. So just to set the context, as we talk about energy transition, any transition by definition needs to have a balance. And we are looking at a transition from legacy traditional sources, which we have been consuming for hundreds of years and growing, into low carbon sources. And that balance is important because it is the essence of any economy to have access and affordability of energy sources. Just to share some numbers, if you look at the two pools of investment, one is the traditional investment, and from about $1.5 trillion of investment that is to happen in the hydrocarbons and fossil fuels, we are about 1.2, and that also after the energy crisis when the investments have increased. So there is a steady tempering and eventual decline, because by 2030 that 1.2 is expected to become 600 billion. By 2050, that's expected to become 200 billion. So investment in traditional energy sources is expected to come down if we are going to be aligning ourselves to the climate goals. Now, what does that mean? That means that the investments in the renewable side has to pick up pace, at least at the same pace, if not more, to compensate so that the energy accessibility and affordability is not impeded, especially for developing countries. Numbers on that, we are today at about $1.8 trillion of investment, expected to be $4.5 trillion by 2030. And that is significant increase in investments on many technologies which are still to be tested. Maybe a solar and wind, we have come some way. But as we go further down into more synthetic fuels, into more storage, we will start getting into areas which are more and more technological and economically challenged. So with that context, now, boiling it down to India, we will continue to be a heavily energy consuming nation. We will be one of the fastest growing energy consumers in the world, from about 1.3 trillion terawatt hour that we see now. We are going to go to about 2.5. Our oil and gas consumption is expected to increase by 40% by 2030. It will not taper off, possibly even till the middle of next decade, and so on. So as India, we need to draw investments into both pools. And since energy remains a global commodity, how investments happen globally impacts us in terms of the price, in terms of availability of fuel. So with that context, let me start the discussion. And the focus that I wanted to bring in is to how do we see the different expectations and approaches that both users and providers of finance in the space of energy are going to bring in. So Rouzbeh, you're looking at investments in the upstream side. You work closely in India looking at acquisitions of international oil and gas assets, and they are at the center of many of these discussions in terms of the returns on expectations, in terms of how capital is getting allocated, and of course access to capital, which remains very central to growth in oil and gas. So from your perspective, how do you see the landscape changing, and how are players and companies organizing themselves for it?
So let me start with the traditional side first, and then we migrate into sort of the transition space, new energies. I think the bottom line is any good new hydrocarbon project will raise the funding it requires, both the equity and the debt. But what we are seeing is that traditional providers of finance are vacating the space. There is a lot of pressure, and some of the more traditional banks, we used to call them RBL lenders, for example, in our older industries, they're vacating the space. So what that has meant is there are some institutions that have come in. These could be credit funds, these could be traders that are filling the void quite effectively. Where does the equity come from? Look, again, the traditional providers of equity have also vacated the space to some extent. But as long as a project is showing the results and the returns, you will raise the money. So that's my first statement. But there are some elements that needs to be fulfilled. So for example, a traditional hydrocarbon business needs to be low in emissions, the interest will be in gas over oil, and there is other things that need to sort of be in place for the interest to be there by the funding community. On the new energy side, and in new energies, we need to differentiate between the molecule-based transition and the renewable space. The business model needs to be sustainable, and it hurts me to say that, but you need to make money, right? There needs to be a business plan, and returns need to be there to attract the capital that is required to fund these things. What I've seen in my experience is national oil companies, state-owned companies are quite aggressively pursuing the space because they don't have shareholders to respond to. However, if you are a publicly listed company and you need to respond to shareholders on a periodic basis and you show them lower returns, it's difficult, right? So we are in a kind of a stalemate a little bit, and where you are having to differentiate between this is my traditional line of business and this is how I make money, towards this is a new undiscovered line of business and this is how I will make money, but please give me the time that is required. Some of the green shoots we do, however, see is there's a lot of private equity capital being raised. That private equity capital has been aggressively put into the transition space. And there is a lot of dry powder still being made available. One of the issues that we still see is that the infrastructure is still not there to allow for a lot of these projects and businesses really coming to the front line where they are supposed to be. So once we put all of these things into space, then the last piece of the puzzle can be solved as well. But then the overarching thing is as well, you need support from the governments, right? The government has to play an important role here. Subsidies need to be in place. The right framework needs to be in place. There needs to be a regulatory process. It needs to be easy and effective. And with the governments and the regulators' help, things will be made possible. Sorry, quite a long answer to a very short
Thanks, Rouzbeh. In fact, we will have us almost, I would like your views on the regulatory and policy side separately. And that is a very important part of the puzzle, because this, the demand-supply balance will largely be led a lot through that. But outside of that, and I'll come to you, Mannish, the point you made about the access to capital is a lot on bankable projects and returns, and maybe the large balance sheet based borrowing is still okay. But as you look at independents, and that's where I'll come in to you, Mannish, you are private equity backed. You are invested in the entire value chain, starting from being an independent E&P, but also now looking at gas and maybe new energies. How do you reflect on what Rouzbeh was talking about, the access to capital, what has happened in the past, and how do you see the future playing out?
Thanks, Anirban. I think I would just reiterate what mentioned about the access to capital is there, as long as there is a project having an ability to provide not just the return of capital, but return on capital. And I think that's phenomenal, because even in the traditional projects which we are pursuing, we do have access to both debt and equity, though we are predominantly equity funded. Let me just kind of segue into the nature of projects which we are doing more often. We are focusing on producing and near producing properties. And it's important, I think, not just we as an independent, a lot of independents and invariably also increasing independent international energy companies, they are chasing the advantaged resources. And by that I mean those resources which are lowest cost, least risk, which can be put on production quickly, and they are not locking in large emissions over a period of time, or either becoming stranded in a short period of time. So as long as this we are able to demonstrate to the class of investors that yes, we have the ability to meet these criterias, we are getting the right kind of resources. As far as our low to no carbon business is concerned, and I think that's this important, which we do have it in our portfolio. It helps us to demonstrate that yes, we are, while we continue to provide to meet the domestic demand which is there, but also we are working on making sure that as the phase out happens, we would be future ready. And in this, I have a classic example that we understand the molecules better than the electrons. So we are not kind of going and getting into making renewable energy. We know the rocks, we know the molecules. So what we are trying to do is we are trying to leverage on what we know better. And there our focus is on CCUS. I pause over here, but if you have any follow-on questions, I would be happy to.
Yeah, let me come back to you on that, and I'll take a segue to you, Hitesh. You are very central to India's oil and gas sufficiency, to whatever extent that we have sufficiency, and also your broader hat that you wear as part of the broader Vedanta group, where not just the E&P for oil and gas, but also resources, and as a group, your movement towards reducing your carbon emissions. So you have a bird's eye view of the capital investment philosophy that you're looking in oil and gas, and to reflect Manish's point on how do you look at that, but also in the broader resources space. And as an investor in the renewable side, which is now getting into the electrons, how are you looking at investments? Because these are very different asset classes. And as a CFO, how do you balance your approach across the three of them?
Correct. Yeah, I think, wearing the larger Vedanta hat, right? So we are a company which produces not only just oil and gas, but critical metals. We are into mining and all. So we are producing for India, and as a country we need it, right? Whether it is oil, whether it is aluminium or zinc, India needs it, and in fact whatever we produce is still not enough, right? So that part cannot be taken away. Now the important part is everybody, not just us but the whole world, has realized that we need to do something about climate, right? So that is also something which is not going to wish away, right? And we need to ensure that our next generation doesn't suffer because of our actions. So that also we are very conscious of, right? And as an organization we look at it as not at something which we are compelled to do or which we should be doing it, but we try to figure out as a way of means of business, right? So our net zero target, for example, right, is 2015. But every businesses, like oil and gas, it is 2030. Every business has their own target. But the more important part is what actions we are doing, and how do our actions result into something which doesn't impact our ability to raise funds. So for example, in our say zinc or aluminum business, right? If we are able to produce through a green mechanism, are we able to is it a green aluminum, is it a green zinc? The value which we get is disproportionate from our customers as well, because everybody wants to be part of that journey, right? So that's the investment which we are trying to do, and if we do that right, obviously the funding will definitely come, because people will differentiate that what we are doing and what we were doing in past. The other factor is in terms of as the other two members have also said, ultimately whatever we have to do, there are two parts to it. One, whether it is making money or not, right? Fundamentally, that will not change for whatever we try to do, right? The second part is, as an investor, whether somebody is an equity or a debt investor, what they look at is what actions are we doing, and those actions are not just the statements which we make, right? But year on year, what are the targets? Are we getting us, certified, externally? Are we voluntarily doing it? And whether that is resulting into a change year on year. If those actions are visible, I mean, you will not have to chase money. Money will chase you because it would mean that you are in the right direction. So maybe in a summary, I want to just capture what we are trying to do as an organization.
So at the heart of it is the conscientious decision making that you're doing with a long-term horizon in mind. And coming to you, Mr. Das, if I can call IREDA almost one of the founding fathers of the renewable journey that India has undertaken. You have looked very, very closely in solar and wind at a time when investment used to be considered not as straightforward as it is today, and chart that journey to where you are here today. And again, you're looking at maybe expanding yourself into doing that for EVs and other areas that you feel are going to come up, and possibly help India chart the same journey that we have done for renewable wind. And from your perspective, as you see, from a traditional energy perspective, there is investments which are coming into this space, but they will require very different thinking in terms of how the capital allocation, in terms of return expectations, in terms of the risk coverage that the capital will draw. So maybe to get your sense, both your experiences and learning in India as you have come through the solar and wind, and how you have gone through the journey to scale it up to get it here, and the path forward. Do you think that the challenges are similar and we will overcome, or are there significantly different paths that we'll have to track to be able to get to our targets for 2030?
Yeah. Thank you, Anirban. And it is not solar and wind, it is solar, wind and small hydro.
Of course.
But small hydro was the true definition of RE. In November 2019, India redefined RE and brought in the large hydro into RE in realignment of the global standards. So in true sense and spirit, whatever was renewable energy defined by Government of India till November 19, IREDA was solely doing that kind of activity from the day one of the renewable energy development in the country. So that we say, or our developer accepts us also as a mother financing organization. It is not financing, it is hand-holding for development of the sector. That what we have done. Whatever today we are finding, those we call today vanilla RE or traditional RE. What we had experienced 25 years back, 20 years back, 15 years back, same kind of experiences we are getting now in emerging, particularly in EV, storage, organic hydrogen and HCl. Those days also there used to be viability gap, generation-based incentive, so government used to come and handle that. If you see 15 years back, yesterday I was talking with one of our existing borrower, 17 rupees per unit tariff they have signed. And today it is 2.5 on an average, even it went down to as low as 1.99. But finally it is the most competitive 2.5, it is still doable in India. And in India also solar, if you see, probably we are the cheapest if you compare with the global cost per unit here. So the experience what we have gained, that experience we have translated into results in IREDA, which has already been reflected in our IPO. In the past, we have attempted twice, in November 17 as well as November 19. But we did not do the IPO. There was a concern in the market, not only for IREDA, but also for renewable energy sector investment. And post IPO, not only in India we have established that renewable energy is challenging, but it is not that what it is perceived when you talk about the risk perception is in place. We have taken all kind of fair amount of risk mitigation mechanism in place, and we ensured we maintain extremely good quality of loan book in our accounts. If you see so far, we have financed more than 1.15 lakh crores for RE projects. That is almost around 20 to 23 gigawatt of capacity installed in the country. And if you see in the capacity gigawatt installed in terms, may not be that high percentage, because we have financed the project which was 70 crore per megawatt, 24 crore per megawatt. Today it is 4 crore per megawatt. So if you see with cumulative disbursement of 1.15 lakh crore and cumulative sanction of 1.70 lakh crore, our cumulative write-off till date, I am talking since it is a listed company, I cannot talk till date, I am talking of till December 31st, what published data we have given. Our cumulative write-off is 202 crore. You look at with a 1.15 lakh crore financing, only 202 crore is the write-off. And out of that write-off, we must have realized something also. Assuming zero realization, 202 divided by 1.15 lakh crore. It is not even 0.02%. So renewable is challenging. If you manage it sincerely and with full discipline, we can overcome and we can enjoy that benefit which you are enjoying now in IPO. I am touching again and again IPO. The reason is the bankers or the agencies involved in this activities, nobody could develop that kind of fair amount of confidence that this is going to do like this. But there was reason, because we being a government entity, DIPAM deals with these matters. And DIPAM had done in the past many IPOs, so they have their experience. And as I said in the past, twice IREDA attempted and came back. Even up to the road, so we came back. Now we have established what is exhibited in our fundamental, in our financials, that is truly reflected and that is truly respected by the investor community. Now coming to the emerging and developing new sectors, our ministry's name is New and Renewable Energy. So it is not simple renewable energy. And when you talk about new and renewable energy, all your future energy requirement, you are going to get 90% of that in India. Already Honorable Prime Minister yesterday while inaugurating, he has again reinforced that we are going to become third largest economy very soon. And we are going to become net zero by 2070, but 2070 is quite long. But by 2047, we are going to become energy independent, as well as we are going to become a developed economy. And one cannot become a developed economy if you do not have a holistic development in your entire economic value chain. And for every development, you require energy. And for every energy, you require 90% new and renewable energy. So huge amount of opportunity is there. So what is happening now from the developer side is there. They are not looking at IRR. They are looking at largely cash flow. The moment they are setting up the plant, once it is COD is over and the testing period is over, they are trying to take out the cash flow and trying to set up the new project. Since new and renewable is challenging and emerging, technology centric, so those who have established track record, they are having fair amount of confidence to further reinvest. So therefore, any completely new player coming to this sector is taking time. If you look at in India, ethanol and compressed biogas, these two segments government promoted last year, almost 1.5 years back. You were touching upon government policy because government of India has taken fair amount of policies with respect to handholding, not supporting, handholding for fastest development of RE in the country. And if you see ethanol, initially we planned around 10% blending. Then we went to 15% blending. Fair amount of new developer, they are Indian developer, not fund-based developers. In solar and wind, you will find fund-based developers are there. Small hydro, you will not find any fund-based developer are there. But time has come now. When you look at storage, you need to look at storage. The reason is our new and additional energy when we are going to get from new sources, that is green hydrogen and its derivative, it is going to take the fair amount of significance. Today it is not economically, commercially not viable. Therefore the government has come out with viability gap funding. But to have green hydrogen, you need to have RE power and continuous RE power. RE itself, the traditional RE itself is intermittent nature. So you need a fair amount of storage, so round the clock power will be required. So fair amount of investment, these funds are going to certainly look into solar, wind, hydro, and those who are having those pump storage facility and all. And these Indian developers, particularly hydro developers, many of the funds are now targeting to acquire them also. My belief is that, and our team's belief is that, storage in back of their mind. And today, since the business potential is pretty huge, we have hardly 182 gigawatt installed capacity now, and we are going to reach 500 gigawatt capacity by 2030. So roughly around 320 gigawatt addition is going to happen, which requires around 30 lakh crores of investment. Still, in fossil, we are going to have 3 lakh crores of investment. Why? It is not double standard. It is a very intelligent way of managing energy security and energy management in the country. We have to go to the new sources. We have to look into energy transition, not only RE development, energy transition as well as decarbonization. So holistic efforts are being made, and all the new developers, those who have established in RE space already, they are going to certainly encash this benefit faster, and the new upcoming developer certainly will come forward, but they have to come with a word of caution. So while lender, and what is happening from lender's perspective, the way the lenders used to deal earlier, they have to change their mindset also. Because here speed is the essence of the business. Unlike fossil fuel, where you have some 5 years, 4 years of construction period, here 6 months to 1.5 year construction period. If suppose you have a international support funding is there, which used to be generally in IREDA earlier, prior to 3.5 years, our resource base was 70% from forex sources. It has come down to now 25%. That means we are not using the line of credit from the foreign channels. The reason is our landed cost today is becoming most competitive vis-a-vis their cost. So these agencies, even their process of appraisal and disbursement is quite longer. If we need to ensure faster development and ensure support to the developer and also ensure the lender's concern, these developmental agencies also to realign with the current requirement and amend their appraisal mechanism, speed up the thing without compromising governance standards. I am touching governance standards means today IREDA is considered one of the best governed NBFC, not government NBFC by RBI. Earlier it used to be considered as one of the best governed government NBFC. So that tagline is gone. Now, why governance is required? If governance is good, your rating is good. If your rating is good, your borrowing cost will come down. If your borrowing cost will come down, you can lend at a lower rate. If you can lend at a lower rate, your project is going to become viable. But at the same time, the borrower has to ensure best quality corporate governance standards in order to have a better rating so that they can take the most benefit out of it.
So in some way, the question, the segue question for you, sort of frames itself, right? A couple of points I'll pick from what Mr. Das said. The renewable sector in India, the opportunity is immense and we need not debate on that. But also that once you have and be able to narrow down your approach as an investor, you can identify pockets which on the face of it may look with a higher risk, but they are the ones that pay off long term in the future. So let me bring back an element that we keep hearing, that this is one space, climate investments, in which there is more funds available than there are bankable projects. And especially in the space that even the funds that are flowing into these fields tend to go more towards slightly more mature spaces, like your solar and wind, rather than some of the more new and renewable sources, more the new sources that are coming in, which require possibly equal, if not more, investments in a very concerted way. So as you look at this entire space, you run a large fund which is looking at climate investments. How do you look at the spread and maybe narrow down on your views on the India opportunity? Where do the pockets lie where you feel more positive than the others going forward?
Super, thank you. Can you hear me? So I'm going to step back and talk about emissions for a second. Because if we're talking about climate, and we start with the capital, you forget what your target is, right? And our target is emissions. And if I look at private capital to this point, historically as well as today, 80% of private capital that is addressed to climate goes to renewables or lightweight electric vehicles. How much of emissions do you think that will solve in the world, percentage-wise? Any guesses? About 20%. But that's where 80% of private capital goes, right? So we got a little bit of a mismatch, right? We've got and then we've also got a geographic mismatch because most of this capital is going into the West, whereas in Asia, India, we need this capital flowing. So there's a mismatch from emissions perspective in terms of where we're putting capital. Now I'm going to move to some of the comments from my colleagues here who are also working in the big corporations now who've really got that net zero, which may not be renewables, but all these other industrials, right? Which is 80% of the emissions. If you look across the rest of energy, industry, transportation, buildings, that's 80% of the agriculture, 80% of the emissions. A lot of the rhetoric and what we hear, the announcements, the big things that really catch your eye is hydrogen, right? Ammonia, we get the fusion, the nuclear. These are all going to take multiple decades, right, to get into scale. So we have this dichotomy of private capital going to renewables, which solves 20% of the problem. The other 80, we're looking at these technologies that are doable. We know how to do them, but scaling takes multiple decades. And just to give you a view, I come from renewables, and we spent 30 years getting wind turbines from 3 kilowatts to 3 megawatts and stopping the blades from falling down, right? That's what we did. It's going to be the same for large infrastructure. So then you say to yourself, okay, what can I do? Because you do need a lot of government intervention. You need a lot of pieces in the supply chain to get hydrogen at scale. So that's going to take decades. So what can we do today, which is your question? I think there is some low-hanging fruit, and there's a very, very important reason to do those, to get those under control. The first is, with this use of fossil fuels, we've got to eliminate methane emissions. It is much more potent, between 28 and 80 times, depending on the time scale, than carbon dioxide. Whether it's a coal plant or an oil plant or a gas plant, we've got to get rid of methane emissions. We have all the technologies, and oftentimes, I mean, my company, my portfolio has already delivered 90 million tons of CO2 reduction, right? And it's primarily from methane, and it's less than $10 a ton, right? Sometimes it's negative. So it's not like it's very, very doable. We don't need a lot of policy for it. So that's the first step, and it gives us capacity. Capacity means it gives us a few more years to achieve our 1.5 or 2 degrees. The second area is efficiency. If you look at our energy systems, from primary energy being created to before you turn on the lights to the use, we are 2/3 of that primary energy is wasted. So once you turn on those lights, it's probably closer to 3/4. And this is worldwide figures, no different from India, really, right? So if you think of all that waste, if we start solving those problems, we save money as well as we save emissions, we save resources. But the most important reason to do it is because whether it's hydrogen or renewables, none of these new sources have the same energy density as fossil fuels. So to then overlay that on an ineffective, inefficient system is going to cost us a lot of money, and that's why we think it's unaffordable. So that's my...
And if I can bring in a bridging element between the two, that there is the traditional fossil fuels, and then on the far end is your green electrons, and maybe green electrons converting to e-fuels and molecules, which will significantly change the game. But there is an interim period in which the transition has to happen. I'll come to you, Manish, for that, is a little bit of view on gas. That we have talked a lot for a long time about gas being a transition fuel, its intensity, emission intensity being lower than many of the traditional fossil fuels. But at the same time, the longevity of gas remains in question, especially with this transition and the pace at which the transition has happened. You are invested in that value chain of gas, and maybe a quick view on how do you see that transition playing that, so that beyond the solar and wind and some bit of hydro, until the time we get at scale the hydrogens and e-fuels, what role do you see gas playing in for us to be on track to achieving targets while not compromising on the energy security part of it?
That's a very valid point. I think gas is acting as a bridge fuel to help us transition to a net zero carbon world. I think if you look at any other possibility, any other technology, clean technology, new technology, I don't think we have that full substitutionality. Neither we do have the scale at which these could be rolled out. Additionally, we also have the hard to abate sectors where you need direct source of energy. And I think gas fits in very well within this. As far as the carbon emission intensity is concerned, it is nearly 1/3 for coal, half of it for oil, So it kind of plays that bridge fuel. We, as far as our company is concerned, we are trying to see how do we phase out the coal by going to a low carbon natural gas in the Rust Belt of India. And it so happens that other than coal, there is no other source of energy over there. And the good thing is the liquefied natural gas molecules are easily available. The trades are there. We do have virtual networks, not just the metal networks, but the virtual networks, through which we are in a position to provide this. As far as the gas will continue to play a big role, coupled with some of these decarbonization technologies. So we do see a role for gas, even in a net zero world. It's how do we take care of the residual emissions that's so critical.
And while that debate plays out, I'll come to you, Hitesh, is that likely cleaner oil in way that you were describing, a decarbonized upstream oil and gas company, more gas, possibly some elements of cleaning up our upstream methane emissions that Pratima talked about. And these are all going to require investments. Right? And as an oil and gas company, you're increasingly relooking at your margins, at your investment returns. And I'll now shift gears a little bit towards the environment and the regulation and the government policy support. Is that as you look at making these investments on the back of your core business, which itself is going through a transition, what is the current scenario that you see in terms of encouraging investments, in terms of policy support, in terms of maybe in some cases subsidy supports, and what do you feel would be required for you to transition into a more cleaner generator of fuels in line with the decarbonization goals of India?
Okay, so probably I'll answer in two parts, right? One is on our traditional business of oil and gas, right? Now there of course, as Manish said, gas is a transitional fuel, right? So we also, and as a country also, forget about Cairn. Yesterday the Prime Minister again said that from 16% we have to get to 15%, right? For India, I mean that is a major step. It will help us to move away from say coal. So I think that's an area where we need more support. One part which has worked well is getting the networks, the pipeline networks availability for the licenses for CGD and all. 99% of India is already covered. So that part has been completed. Now the important part is the licensing and pipeline is one part, but the next part would be how do we ensure that gas is produced, the consumers adapt it, especially from an industrial side, right, and the vehicular side. So a lot of efforts now need to be done on those licenses which have been given. How do we ensure that the investment happens, people start adapting it, and there is a lot of substitute competition as well, right? So for example, people still use LPGs and there is a subsidy for a large part of the population. Giving a gas pipeline will not help because it has to be competitive for them in terms of the money which goes out from their pocket. Similarly, for a lot of industrial users as well, right, they have substitutes, and with gas, the problem which they have is the price, right? If it fluctuates too much, right, for them it doesn't work. So how do we ensure that while from a producer side, obviously we want a higher price for us to invest, but we also understand that there is a price point beyond which the consumer will move out. So what's that right price point for that? And in the oil and gas sector, the traditional one is heavily taxed. Right now, with government levies at as high as 70%, it doesn't work. And for India to move to 15%, we can't rely only on the imported gas. While currently as a country we still produce 55%, but the number has to move up. So that's one part of aspect where the infra is there, but more importantly, how do we ensure that the consumption starts? And second part is what fiscal support, the production also gets a benefit. The other part, where we are also into renewable, right, for our at least internal consumption. As I said, Vedanta as a business, we consume, our power, requirement is huge. And that's why we have moved into renewable. What we want to do is our operation should be, driven by the renewables. And we have set up a company, large projects, and they're working fine. In fact, if you ask me, the pace of their, development is much faster than what I would have anticipated because I'm on the other side of the oil and gas. But they are coming up well. But I think, and they are coming up well because there is lot of support which has already come from regulator, from government. But I think more needs to be done in terms of ensuring that, how do we give the access, how do we give that those licenses, how do we approve that projects, how do we support in the funding of those projects. I think, in the early stages, I see a lot of positive action. And I think those action needs to be continued going forward. And I see a big change in that. We also heard, we are not seeing MPAs in that, right? So that's a good sign, right? Because people will make money, right? Only thing we'll have to ensure that this momentum continues and the benefits which are there, right, continues. Because what we see in a country, we a lot of time become money minded, revenue minded, and wherever people start making money, we start taxing it, right? So we have to balance that out and ensure that things work the way they are designed to work, and it will support our common objective of reaching to that net zero target.
Thanks, Hitesh. And I think much that we would all want that. I think eventually we want to run businesses as commercial entities. So, Mr. Das, if I can come to you, I think we heard from Hitesh a little bit about, for example, if you want to scale up gas, there are certain structural support that will be required. I think even more so when we look at the new and renewable sources that you were talking about. We have seen that many of them play out in the past. The renewable purchase obligations, the PAT schemes, even now we are talking about carbon markets to come in. And wanted your view a little bit of gazing into the future, that as we look at accelerating and both production and adoption of some of the new fuels, some of the ones that you talked about and Pratima talked about, is the beyond the solar, wind and small hydro, as you go into EVs, into battery storages, into e-methanols and ammonia. What do you feel some of these structural changes and maybe slightly broader ecosystem support that you feel is being thought about or will be required for us to make that leap?
See, the kind of energy requirement what we are having, even if you completely cover the entire India with solar, it will not be fulfilled. If you complete the entire globe with solar, hardly 10% of our requirement can be fulfilled. So, and then moreover, solar requires land, fair amount of land. And land is the scarcest of the resource what is available to us. Now we have to very consciously use. The land which is not having a potential use, not only today, certainty of not having potential use for next 25 years. Those are to be used for solar or wind, whatever. And hydro, again, you cannot do on any land. You require to have that water bodies and all. So it has its own limitation. Then since it is intermittent, we may need to make it round the clock. We have to have alternate sources. See, that is the reason, if you see our investment pattern in fossil versus non-fossil, 5 years back it was 1:1. During these 5 years it's 1 to 1.7. That is 1 is fossil and 1.7 is here. And it is going to be 1 to 10. When I said 30 lakh crore will be required and only 3 lakh crore will be towards fossil. So that means we need to have that kind of fossil sources dependency till we become that kind of energy security sufficiency in place. So solar, wind, hydro, it will grow with its limitation. These alternate sources, be it gas, coal, whatever, but we have to have very minimum kind of thing. That is the reason 3 lakh crore we are hardly around 20 to 30 gigawatt has been planned against another 310 gigawatt, 20 gigawatt of additional capacity planned for non-fossil. So this will continue. And if you see our government of India's policy also, government is very conscious. If you see the recent COP28 program, we are not signatory to that. People might feel in a sense India is talking so much of gaga, then why they did not sign in that? Because we have to ensure energy security. And we have the largest population in the world. We have to ensure that everybody is getting, and then we have already set up fair amount of fossil capacity in the country. We cannot overnight shut it. So we need to have a gradual and phased manner transition in the time to come. And I'm sure not only our Indian audience, the global audience also will agree with our Honorable Prime Minister's commitment and conviction and clarity on which we are trying to develop, supporting the developer through policy measures, banking modes. I'll touch upon a little bit of international finance again. The reason is, which is traditional IRE or vanilla IRE today, 15, 20, 25 years back, all these multilateral agencies, they handholded us. They provided the cheaper funds, which they are again going to play a key role in that. And which was cheaper then, it is not becoming cheaper now, largely because of the geopolitical situation, global dynamics, and today the landed cost what they are trying to give us, it has not become competitive. Now in the new and emerging, unless you bring down the cost of fund to an acceptable level, till such time the project is not going to become viable. And again, when the developer is depending on government, normally there is a fair amount of uncertainty what will happen to government policy changes. So they need fair amount of certainty in that. So we need to work out how best we can bring down the cost of funds and how best we can reduce the cycle time of construction period, that is concept to construction completion or COD, that is also reduced. That can happen through transparency, digitization and ease of doing business. And India and Government of India is very, very fairly working on it, and already we have proven that. And probably our ministry, even other ministries must be happening. Every month we are doing a stakeholders meet to try to understand the concern of the stakeholders in the sector. Whether any policy realignment, whether any handholding, and the developer concern, whatever is there. So normally in a lending and borrowing relationship, there used to be fair amount of asymmetry in information. All the three agencies, developer, lender, and the policymaker, have to work towards completely removing that asymmetry in information. And we need to know that who is doing what and who is answerable or accountable for what. And I'm sure with that kind of mindset, we can achieve our target. What is it?
Thank you, Mr. Das. In fact, I'm going to pick on the point you made about need to bring down the cost of capital is going to be central to this theme of making sure the energy pathways, whichever we choose, is going to be sustainable for India as a country, especially when we are not going to put energy security and energy accessibility at risk. So maybe Rouzbeh and then Pratima, I'll come to you. I wanted to bring this discussion from that point into the blended finance discussion. That we obviously cannot, to make this transition, it cannot be on the back of public finances. It cannot be on the back of commercial debt. It cannot be on the back of purely concessional debt to a certain extent. But different pools of capital have to come together, enabled by an ecosystem of government, regulatory and supports. And that could include public finances to a certain extent, but it will include, I think you talked about the developmental multilateral financial institutions that are coming in and taking different types of risk. There is a different role to be played for concessional and more patient capital and so on. So from your vantage point again, India, we have not yet been able to get our share of that blended pool of capital. Numbers put it at about 200 billion a year is what we need. We are at about 30 to 40 billion, take your pick. What will it take to bridge that part of the gap? And the entire spectrum remains open, and maybe your experience from other countries as well. There is an element of the taxonomy that has to come into place, but also how do you bring in different pools of capital and then support the investments that are being made here for us to. So what is the missing link that we have to target to bring in the different tranches together?
Unfortunately, I don't have the secret sauce, right? I mean, that would be very, very easy to say. But it is interesting to see how, for example, I grew up in Germany. Germany did it completely different, right? Germany made the end consumer pay, right? So every month on your electricity bill, there was a subsidy line, right? And that allowed for a lot of what appeared to be economically more challenging projects to come off the ground. The way America is doing it right now is completely different, right? They're just throwing a lot of money at the problem to solve it. A lot of it is politically driven. I think it just needs to be a pool of different forces coming into effect to make it work. But what I see in India in particular, I mean, it's one of the most entrepreneurial places I ever visit. I mean, you have brilliant people coming up with brilliant ideas, and this by itself will be the driving force of innovation that then brings economic business models and financeability with it. But let's also not forget, I think I heard two phrases at COP, which I always will remember. One of the first phrases it was from the African continent by the head of the sort of supernatural organization. The two of them, I don't want to name them out, so you may find out who it was. He told me you cannot decarbonize a nation that has never been carbonized before, right? So that's one of the issues, a lot of countries in the world face. They get the support of the World Bank, they get the support of the IFC. There is a lot of support that then allows some of these cleaner transition companies be more effective, to address one of your questions. But then there's also a lot of success stories of more developed nations. I mean, this is a completely different industry, but again, an anecdote from a couple months ago is, if you look at the car industry, look what the car industry has achieved over the last 10 years. It's impressive, right? Some of the car brands we will always thought they are the pinnacle of human engineering will maybe never exist again, right? Because the entire business model has shifted. So I'm hopeful, and I'm encouraged to see what's coming next. But a lot of different forces have to play in hand. So it's fiscal, it's monetary, it's governments, it's regulation, and it's the end consumer. I think it all has to come hand in hand.
Pratima, you have the secret sauce for us?
I think India has a secret sauce. And the secret sauce is all the money that was put into the fantastic education in India. And yet, I see that my personal opinion, because I've worked in China, worked in the United States, Denmark, the United Kingdom, I don't see us taking full advantage of it. And that's what I feel. If you look at the West, we are enamored by R&D. We constantly are in this R&D churn, and we innovate. That's what we call innovate, innovate, innovate. Constantly doing new things. And then I go to China. I used to run a business once, licensing business. I had 63 plants worldwide, 32 in China, right? The Chinese would pick just one. It could be flawed, but they'd rinse and repeat, rinse and repeat, rinse and repeat, till they got it like scaled and low cost. And by the time I left the business, we would actually be able to build, from this time we gave them the license to when it was operating, was 12 months in China and 36 months in the West, right? And so I'd say, why isn't India in that position, right? We call it hard to abate sectors. Whoever coined that phrase, they're wrong. They're not hard to abate. We just never invested in them. Who invested in clean cement and clean steel and using mining tailings and making them into high-value alloys? I have investments in all of those. We just didn't. But all these companies are available to you. They're available, and these ideas are there. Who's going to scale them, right? The West never has the patience to scale them. That's why they all end up in China, right? But India has so much potential because you have the capability, you have the patience, and now we have the infrastructure. And we've proved it in IT, we've proven it in pharma. Why not in cement and steel and power generation and other things? And we talk about government incentives. Well, those IITs and IIMs were all set up. So I do think we have some raw material that is still to be plumbed.
Okay, and I think there is always a clear, some of the results, and IREDA is an example that when you do take the first leap on innovation, it plays out in the long run. It gives you a competitive moat, which then becomes very difficult for others to come through. We have the last 5 minutes, and I just wanted a minute from all of us is a crystal ball gazing, that we are all placing our bets on the energy pathway for India. And of course, there is no right or no wrong, but just your thoughts on, if you had $100 and you had to place a bet for the next few years on, and it is across the board, of course, fossil fuels continues, gas has a transition fuel continues, but more on the new and renewable energy. And now there is that entire spectrum of them, right? From different colors of hydrogen to ammonia to synthetic fuels, methanol, and of course, even the biofuel side that is now coming in. And there is one element which keeps coming up is that whichever path we choose, we should go all in. After that, only then we will be able to build the kind of scale that we will, and then eventually the costs come down sooner than others. So just a minute of your time on your crystal ball gazing, looking at India today, which are the big next scalable, new and renewable businesses that you feel are a few years away, not decades away. So maybe with Rouzbeh, if we can start with you.
Pressure is on. I was hoping to build on somebody else's idea here. But I think one area that requires immediate attention is the infrastructure, and I made that point very early on, right? Because without having the right infrastructure in place, you cannot actually use a lot of the renewable energy that you want to build, right? So, and that, as boring as it sounds, it's investment into the grid, making sure that all sources of infrastructure is available to actually make use of the energy source of choice.
Manish?
I would say continue to put the money where our mind is. And besides the traditional sources, of course, gravitating towards low carbon. CCUS is something which has tremendous potential. We would continue to put our money on that. And while it is a bit early in the hydrogen promise is very much there. It has tremendous possibilities, a lot of opportunities, but I think we are still evaluating in terms of the opportunities which we are going to talk about it.
Yeah, I think CCUS we did not discuss much in detail in the session, but that is a part of the puzzle which is an inevitability, that if we have to get to zero, then at some point, especially for hard to abate sectors, it has to come in. So yes. Hitesh, your views?
Same, I think first on the carbon capture for us, that is also, given the business we are in, it's a business opportunity, not necessarily a net zero, right? So that is there. But I think if I look at the renewal part also, the round the clock, wind and solar for all industrial uses, as I said, we have seen success much better than what we anticipated. So if we, work on the infrastructure, ensuring that all the regulatory and other things are taken care of, I think for in India it will bring a sea change. If all our industrial, usage moves to this, it's a big change.
Mr. Das, all eyes on you. You are in some way shaping this space as well. So
I think I'll understand your question once again. You said if I'm having $100, where I need to invest? That is, so $40 straight away in vanilla RE.
In where?
Vanilla RE, traditional RE, solar hydro, which is risk free.
okay.
$20 in new, so $40 in new and $20 in emerging. That means $20 in this EV and what already has been emerged like ethanol, CBG and all, $40 in new. Why this 60 I'll tell. In this perceived challenge is there, 20% is perceived challenge, that we can mitigate. So in a sense, my 40 and 20, 60 will be risk free, fairly. 40 I have to take a risk. If I am not going to take a risk, I am not going to get that super profit. Vanilla in vanilla return. Risk carry, higher return. So that way, that combination is going to.
So in a way, financial discipline is what you're saying. And Pratima?
Sustainability is the core. So sustainable energy, sustainable finance, sustainable business. The key word is sustainable.
I think any investment needs balance. You have to stop doing something. So I'm going with stop doing some coal while we do other things.
Thank you so much. This was very educative for me and hope it was useful for the audience as well. But thank you so much for your time. It was a pleasure having you with us. Thank you.
Thank you so much.